You're listening to Maple Leaf with Ryan Williams. Ideas that move a nation.
Canada should be the richest nation on the planet. We have the most natural resources per person in the world, the third largest oil reserves, one of the largest proven LNG reserves, vast mineral deposits, and some of the most productive farmland on Earth. We have world-class universities, innovators, entrepreneurs, and we sit beside the largest, richest economy in human history, our number one trading partner, giving us access that most nations would only dream of. Yet somehow Canada is falling behind. Canada now ranks near the bottom of the G7 for GDP per capita growth. Food bank lines are at record highs. Housing is unaffordable for an entire generation. And nearly 87% of Canadian invented ideas are owned abroad. Meanwhile, monopolies dominate nearly every market, from cell phones to banks, groceries to airlines, and Canadians pay more for less. This podcast is designed to change that conversation. It's based on an economic belief that countries fail when their systems are set up to help a few people at the top instead of letting everyone have a fair chance to work, save, and create new ideas. It's called Maple Lead, a show about how we take our maple leg and turn it into maple lead, how we use ideas to grow a nation. I'm Ryan Williams, and in this first episode, we're going to look at 8 segments that tell the truth about Canada's economy. Our maple leg, and over the next set of podcasts, we'll bring in experts, builders, and thinkers to talk about how we get out of it. Because we have everything we need to lead, we just need the courage to do it. Inflation has hammered Canadians. Look at the line on this chart. Prices in Canada are about 18% higher than in 2020. Even if inflation is down this year, those prices didn't go back down. They're the new floor. Well, why? Because from 2020 to 2022, we hit the economy with an historic 1-2 punch. 1, fiscal. Ottawa's pandemic response totaled about $354 billion. By about 2021-22, of which $344 billion was direct COVID supports. Then we layered non-COVID stimuli on top of that. Budget 2021 added $100 billion over 3 years as a recovery plan, including $30 billion over 5 years for national childcare. Policy choices separate from the initial emergency. 2 is monetary. The Bank of Canada launched quantitative easing and ultimately bought $340 billion of Government of Canada bonds. Its Government of Canada holdings peaked around the $400 to $430 billion range before quantitative tightening. That is a massive money and credit impulse. Put together, that's why the price level jumped and stuck. Even the banks-led research said quantitative easing lifted GDP and added up to 1.8 percentage points to inflation at peak. And this wasn't just Canada. The U.S. passed $4.6 trillion in pandemic relief and then the Inflation Reduction Act with $433 billion in spending. Later re-estimated much higher by budget sources. Same playbook, same result, a higher price level. Meanwhile, Canadian wages since 2019 rose 13%, while overall prices rose 21%, a real pay cut for the middle class. Bottom line, this year's 2.4% inflation is noise. The 2020 to 2024 policy surge, hundreds of billions of dollars of spending plus quantitative easing, moved that level of pricing up. Until we change the policy mix, your dollar won't recover what it lost. When the government printed hundreds of billions and flooded the system with cheap money, it wasn't the working class that won. It was the working class that lost. It was the asset holders. If you owned a home, your equity doubled. If you held stocks, they soared. If you had gold or silver, your portfolio climbed. But if you worked for a paycheck, your real wages barely moved. Even as prices for everything you needed jumped 20%. In short, the wealthy got wealthier, the middle class fell behind, and the people who didn't own assets, the renters, the savers, the small business owners, paid for it through inflation. That's the silent redistribution no one voted for. A decade of easy money, and we ended up with a harder life for most Canadians. Canada's money hasn't just lost value, it's lost meaning. Look at this first chart. If you put in 2000 $100 under your mattress, that purchasing power of that $100 has fallen to only $58. That means what cost you $100 in 2000 now costs almost $170 today. Now look at the second chart, wages. Yes, hourly pay has gone up in dollars from $16.52 in 2000 to just over $30 by 2024. But when adjusted for inflation, Canadians' real wages have only risen about 10 to 12% over 25 years. And here's the third chart, the real story. The red line is the cost of living. The green line is real wages. They start together in 2000, but by 2024, the red line climbs to 165, while wages only reach 111. That gap, that's the erosion of money. That didn't happen just by accident. From 2020 to 2023, the federal government spent more than $600 billion, while only $260 billion was tied directly to pandemic programs. The Bank of Canada's balance sheet exploded from $120 billion to $575 billion in those same years, a nearly five-fold jump. That surge of money flooded the system long after the pandemic ended, and once prices rise, they rarely fall back. Meanwhile, Canada's productivity flatlined. Between 2019 and 2024, U.S. output per worker grew 6%. Canada's fell 3%. So Canadians are earning more paper, but buying less life. And it's not because we're lazy or overpaid. It's because the economy itself isn't creating new value. Inflation is what we feel. Overspending is what caused it. And the result is the slowest growth in real wages since the 1970s. The maple leg isn't just GDP. It's in your wallet. Because until we fix productivity, competition, and innovation, every dollar you earn will keep buying less. When Canadians hear the word productivity, they often think it means working harder. But that's not it. Productivity is how much value we create for every hour worked. And that's where Canada's economy has quietly fallen apart. We're working more, but producing less. Take a look at this chart. It shows real GDP per person, how much the average worker contributes to the economy. Way back in 2000, Canada and the US were neck and neck. But about 2015, the lines split. The US kept climbing, Canada flatlined. By 2024, the average American produces nearly 40% more per person than the average Canadian. That's not a small gap. That's the biggest productivity divide in the modern history of our two countries. So what happened? We didn't stop working. We stopped investing. Business investment per worker in Canada has dropped nearly 20% since 2014, while it's up 30% in the United States. We make it harder to build, slower to permit, and riskier to invest. Capital, the tools, machines, the technology that make people more productive has gone elsewhere. You can't create 21st century output with 20th century rules. But capital isn't the only missing ingredient. We're also short on skills. Look at this chart. Even after cooling from its peak, Canada still has nearly 500,000 unfilled jobs. At its height in 2022, there were over 1 million jobs vacant, the most ever recorded. That gap didn't shrink because we trained workers. It shrank because companies stopped expanding. The skill shortage didn't disappear. The demand for talent did. And the truth is, we barely track what's missing. In many regions, we don't even run regular employer surveys to identify labor gaps. So businesses guess, schools guess, and the economy drifts. Productivity isn't about how long Canadians work. It's about whether the system lets their effort turn into value. And right now, it doesn't. Between regulation, monopoly control, and skill shortages, Canada has built an economy where output is capped no matter how hard people push. When jobs go unfilled, projects stall. When projects stall, productivity drops. And when productivity drops, wages, growth, and living standards all fall behind. This isn't about blaming workers. It's about fixing the system that traps effort instead of amplifying it. We need investment, competition, and workforce planning that actually matches Canadians' talents to the jobs that need them. Because you can't redistribute wealth that isn't being created. And right now, we're creating less of it every year. Canada is in an innovation paradox. We invent, we research, we fund, and then we give it all away. Every year, taxpayers pour over $10 billion into public research, but only 13% of patents filed here belongs to Canadians. The other 87% are owned abroad. This chart says it all. The patent grant rate for Canadian resident businesses has fallen from around 70% in the early 2000s to barely 40% by 2019. And that's not that we stopped innovating, we stopped owning. Phone companies now dominate Canadian filings, while our own and university research lies dormant. Only about 5% of university patents ever reach the market. The rest sit in what's called the Valley of Death. That dead zone costs us roughly 2.7% of GDP, $75 billion a year, and about $5 billion in lost tax revenues. That's wealth generated here, monetized somewhere else. Now let's look at venture capital, the fuel that turns discoveries into companies. In 2021, Canadian startups raised $5 billion in a quarter. By nearly 2025, that's collapsed below $1 billion. And here's the kicker. 80% of that funding comes from American venture capital. So when Canadian firms finally scale, they move south, taking their IP, their jobs, and their taxes with them to the United States. At the same time, 80% of Canadians' data sits on U.S. controlled servers, all accessible under the new U.S. Cloud Act. We're not just losing patents, we're surrendering the entire digital economy, and we need to get our sovereignty back. Consider the pattern. Dalhousie's battery lab, founded by Canadian grants, now powers Tesla's global IP portfolio. Huawei, partnerships, more than 20 Canadian universities produce patents, all owned by China. Since 2016, Ottawa has spent $4.4 billion in AI. 3/4 of the resulting patents being owned by the Chinese and the Americans. That's $30 billion in lost output every year. We have become the world's R&D branch plant. Meanwhile, the US has the CHIPS Act and DARPA. Israel has Jansma. Germany has the Fraunhofer Institutes. In Canada, we have grant programs and good intentions. If we want to reclaim our future, we need to treat intellectual property and data like energy and minerals, strategic assets, not academic outputs. We need sovereign innovation funds to co-invest with private capital. We need a Canadian Innovation and Data Sovereignty Act to keep ownership at home. And we need to break up our monopolies that hoard our markets and starve our startups. Because the future won't be measured in barrels or bushels anymore. It'll be measured in bytes and patents. And unless Canada starts owning what we invent, we'll keep paying for other nations' prosperity while renting our own. Canada added 1.25 million people in 2023, the largest one-year population increase in our history. That's more than the populations of Halifax, Winnipeg, and Quebec City combined in a single year. The problem isn't immigration itself, that it's happening faster than Canada can handle. Our birth rate has fallen to 1.17 children per woman, one of the lowest in the developed world. We rely on newcomers to grow. We have to have immigration, but we're doing it without a plan. Housing, healthcare, and education have all lagged behind. And while population served 3.2% last year, housing completions barely grew at all. The result? A record affordability crisis. Food banks at 4.1 million visits last year in Toronto alone, the most ever recorded in our history. Grocery and gas prices higher than the US despite lower wages. And a middle class struggling to keep up with the very growth the government calls success. Now even Ottawa seems to realize it's gone too far. Study permits for Indian applicants dropped from 149,000 last year to under 10,000 this year, a 93% plunge. That's not reform. That's a course correction after a runaway experiment. We're seeing the first signs of a system that grew too fast for too long. Look, immigration built Canada, but unmanaged growth is breaking it. Without housing, without a workforce planning plan, and without coordination, we're importing people into a system that just can't keep up. And the numbers say it's no longer sustainable. Canada has a monopoly problem. Competition is what keeps capitalism honest, but in Canada, competition barely exists. 5 banks control 85% of all banking assets. 5 grocery stores, 3 Canadian, 2 American, control nearly 80% of what we eat. And 2 airlines dominate 85% of the market. That's not competition, that's consolidation. Even in telecommunications, where innovation should thrive, we have a duopoly that owns all the sub-brands. Rogers owns Fido and Chatter, TELUS owns Koodo, Bell owns Virgin and Lucky Mobile. Canadians think they have a choice, but they don't. Average revenue per user hasn't budged in nearly a decade, and now Rogers has even partnered with Starlink, the only functional low-orbit satellite provider, locking up the last frontier for competition. Banking tells the same story. Open banking was promised in 2018. then delayed to 2022, then again to 2027. The only group that wanted it delayed, the big six banks, because competition means lower fees, more innovation, and consumer control. In a closed system, control is exactly what they want to keep. It's the same in dairy. In supply management, it's not the farmers who benefit, it's the processors. In grocery, it's not the stores, it's distributors. And across all of it, Canada's biggest firms invest just 0.5% of revenue in R&D, while competitive markets like the US invest over 2%. The bigger you get, the less they innovate, the less they serve, and the less Canadians actually get to choose. Trade is supposed to be simple. We produce and sell the stuff we do best. We trade for the rest. That's what Adam Smith called the foundation of prosperity. But Canada has done the opposite. We have the resources, the minerals, the energy, and yet we build a system that makes it almost impossible to get them to market. Look at the numbers. Oil remains a number one export, $147 billion in 2024, but we still can't get LNG terminal running on the East Coast, even though our allies begged for it after Russia invaded Ukraine. Our carbon tax on industry is climbing from $95 a ton to $170 by 2030, while the US sits near $35. That's not competition, that's self-sabotage. And when it comes to mining, S&P Global found it takes an average of 15.7 years for a mine in Canada to go from discovery to production. 15 years. That means a critical mineral project announced today won't deliver a single ounce before 2040. So while the world is racing towards EVs, batteries, clean tech, Canada is still filling out paperwork. We like to say we're a trading nation, but our trade depends almost entirely on one partner, the United States. And that partnership has been tested more in the past 5 years than in the past 50. Instead of strengthening it with energy, infrastructure, and innovation, we spent a decade taxing production, delaying projects, and watching others take our place. Capital is confidence, and Canada has lost it. For the first time in modern history, more investment is leaving our country than coming in. We're not exporting goods anymore, we're exporting opportunity. Look at the chart. In 2015, when the Liberals took office, Canadian investment in the US started to climb, and US investment in Canada began to fall. Fast forward to today. For every dollar that comes in, $2 goes out. That's not globalization, that's retreat. And this is the result. Business investment per capita in the US has surged since 2016, up almost 70%. In Canada, it's flatlined. We've gone from capital deepening to capital shallowing, from building to watching others build, from a country that used to invent the future to one that now rents it. Every dollar that leaves is a signal that our taxes are too high, our rules are too slow, our ambition is too small. You can't build prosperity when you drive away the builders. If innovation is the engine, capital is the fuel, and Canada is running out of gas. Capital flight isn't just money leaving, it's our future leaving. And unless we change course, it's not coming back. We have the tools and the talent to ensure Canada goes from laggard to leader, to be a rich nation that helps its citizens and helps the world. But this is not a story of decline. It's a challenge and a chance to lead again. Join me in future episodes as I sit down with some of the brightest minds in business, policy, and innovation to explore how we take the Canada lag and turn it into the Canada lead. Together, we'll talk about the ideas that move this nation forward, the ones that can rebuild confidence, competitiveness, and pride in the country we all know and we all love. I'm Ryan Williams, and this is Maple Lead.